The great tax mystery. Why do billionaires pay so little? You work hard, you get your paycheck, and you see that chunk taken out for taxes. Then you read about billionaires with more money than some countries, yet they pay a lower tax rate than you. How does that happen? It feels like an elaborate magic trick, doesn't it? We're going to peek behind that very plush, well-guarded curtain. This isn't about shadowy figures sneaking cash onto private jets. No, this is about legally reducing tax bills by enormous amounts. It's called tax avoidance, a world away from tax evasion. Evasion is illegal. Avoidance might get you a feature in a glossy magazine. It's all about knowing the rules, or the sneaky little gaps in those rules. Reports show some of the wealthiest Americans have, in certain years, paid almost nothing in federal income taxes. Let's dive into this fascinating and often infuriating world of high finance tax games. The Rich Person's Tax Toolkit, an introduction to legal dodges. The super rich don't accidentally pay less tax. They have a meticulously crafted plan. Their accountants and lawyers are like highly trained tax code ninjas, finding every conceivable deduction, credit, and loophole. These strategies are often perfectly legal, enshrined within the thousands of pages of the tax code. For most people, income is straightforward. It's your paycheck. But for the wealthy, income is a multifaceted beast. Their money often comes from investments, which generate capital gains taxed at a much lower rate than salary. If they don't sell the asset, they don't pay any tax on its growth. Then there's tax deferral. Why pay taxes today if you can legally put it off until tomorrow? The wealthy can hold on to appreciating assets for years, watching their fortunes swell, all while that growth remains untaxed. They can even borrow against these assets to fund their lifestyles without triggering a tax bill. Navigating this complex world requires specialized expertise, and the wealthy have access to plenty of it. Hiding in plain sight, offshore accounts, and trusty trusts. Offshore accounts conjure images of James Bond villains and luxury yachts, but for many wealthy individuals, it's a legal way to hold assets in low-tax jurisdictions. Think of places like the Cayman Islands or Switzerland, which impose few taxes. Large sums of money are moved to a specially created company or trust in these tax-friendly jurisdictions. The income generated by these offshore assets might be taxed at a lower rate or not at all. Trusts are versatile tools for tax avoidance, going beyond simple inheritance. They can hold various assets, maintain control over them, and shield them from taxes. Trusts can minimize or eliminate estate taxes, ensuring more wealth passes to the next generation tax-free. They can also reduce potential gift taxes and defer or avoid income taxes on the assets held within them. This legal separation creates opportunities for sophisticated tax planning. The deduction dance and loophole limbo making income disappear. We all know about common tax deductions, but the wealthy play in an entirely different league. Their deductions can be on a massive scale, like deducting the costs of a private jet used for business meetings, or classifying a multi-million-dollar ranch as a business to write off its expenses. For the wealthy, the line between personal and business expenses can become wonderfully blurry. That lavish dinner, a crucial networking opportunity, that first-class trip, essential market research. Loopholes are the little gaps and ambiguities in the tax code that allow certain types of income to be taxed at a lower rate or not at all. These loopholes are often the result of intense lobbying efforts by specific industries or wealthy individuals. A classic example is the carried interest loophole, allowing fund managers to have their compensation taxed as capital gains, not ordinary income. This loophole has been criticized for years but persists, showing the enduring influence of lobbying in shaping tax policy. The wealthy exploit every conceivable loophole to minimize their tax burden. Section 5 Legal, yes, fair, the societal price tag of tax avoidance. Much of what we're discussing is perfectly legal. The wealthy use the tax laws as written, with the help of expensive experts. The problem isn't always with the players, but with the game itself. Just because something is legal, does that make it right or fair? That's the trillion-dollar question. When the wealthiest contribute less in taxes, it sparks a debate about fairness and social responsibility. Less tax revenue from the top means less money for public services like schools, hospitals, and infrastructure. This tax avoidance exacerbates income and wealth inequality, creating a wider gap between the haves and the have-nots. It can erode public trust in the fairness of the economic and political system. leading to cynicism and social unrest.